Intangible assets. Intangible assets lack physical substance. Classic examples include software, customer lists, patents, copyrights, and trademarks. Accounting for an intangible asset depends on how it is acquired. Broadly speaking, there are three ways in which we can acquire an intangible asset. Number one, acquired in a business combination. This simply means that you have a company A, which is the acquirer. This acquires a company T, which is the target company. Let's say that company T has some patents, and the fair value of these patents is 100. Once T is acquired and all assets of T come to the balance sheet of A, including the patent needs to be shown at fair value. And that's important because it is possible that the value of the patent on the books over here is equal to 0. Perhaps the patent was developed internally and there is no book value because all costs associated with the patent were expensed. So the book value would be 0. But if the fair value of the patent is 100, then when this patent is shown on the balance sheet of company A, it needs to be shown at fair value, which is 100. As you can imagine, the determination of this fair value requires judgment. An analyst needs to figure out whether this fair value is appropriate or not. The second scenario is as follows. Purchased in situation other than business combination. This is a long-winded way of saying that a company simply purchased the intangible asset such as a patent. Here, obviously, the intangible asset will be recorded at fair value, which most probably is the amount that was paid for the intangible asset. Developed internally, this is where the intangible asset is developed internally by the company, and we will see this on the next slide. Intangible assets developed internally. Under IFRS, research costs are expensed as incurred and development costs are capitalized. This is important. The research phase means that a company is spending money on a given intangible asset, but is not sure whether that intangible asset will actually have a long-term benefit for the company. Since it is not clear that the intangible asset will have a long-term benefit, therefore all cost incurred during the research phase needs to be expensed. Once it is clear that the intangible asset being created is going to have a future benefit, say we have created the prototype, we know it will work, and now we need to develop that into a proper product, then we are in the development phase, and the development costs according to IFRS can be capitalized. US GAAP is more strict. US GAAP says that both research and development costs are to be expensed as incurred. As an analyst, you need to be careful about this, because if you are comparing a US GAAP company with a IFRS company, then the IFRS company is likely to have a higher asset value because it is capitalizing the development cost, whereas the US GAAP company is likely to have lower asset values and higher expenses because this company is expensing development costs. Coming now to software. Software is an important subcategory under intangible assets, and with software there are two possible situations. One is the cost incurred to develop software for sale to others, and the other is software for internal use. Let's look at the sale to others scenario first. Here the cost incurred needs to be expensed until the product's technological feasibility has been established. Subsequent costs should be capitalized. So if you are a software company and you are creating a new software, until such time as you are clear that this product will be saleable, you are supposed to expense. Once the technological feasibility is established and you know you can sell this product, then you can capitalize. Now, clearly there is a lot of subjectivity involved here. When can we say that a product is now technologically feasible? So that decision point can depend or can be different from company to company. You as an analyst need to be aware of that when you are evaluating different software companies. Under IFRS, costs incurred to develop software for internal use should be capitalized once feasibility is established. US GAAP says that we need to capitalize all development costs. Make sure you learn the material on the slide, because the next slide will be a question based on what you are looking at here. Okay, now try to do this. The first thing you need to recognize is that we are talking about an internal software development project. So from the previous slide, this is the third category. The project starts on 1st January 2012, so that's the start of the year. It incurs expenditures of 10,000 per month during the fiscal year ended 31st December 2012. So the cost is being incurred throughout the year. By March 31st, so at the end of month 3, it is clear that the product will be developed successfully and will be used as intended. So the cost incurred during this period is going to be expensed according to IFRS, and then from 3 to 12, this cost will be capitalized according to IFRS. The expense therefore would be 10,000 into 3, which is 30,000, and the amount capitalized would be 10,000 into 9, which would be 90,000. What US GAAP says is that the entire cost for the year needs to be capitalized. So we have 10,000 over a 12-month period, so 120,000 is capitalized. This is a very important table for you to understand, and it's quite testable. When you are comparing a company which capitalizes versus a company which expenses, the total assets are going to be higher for the company which is capitalizing, obviously, because that's what capitalization means. All these other numbers are fairly self-evident, and I want you to go through this and make sure you understand and remember them. Some of these items and ratios that you might have an issue with. So let's look at CFO. Why is CFO higher for the capitalizing firm? The reason is that if a firm is capitalizing, then the money spent, let's take the example that we just saw, the 900 spent, this is going to go in the investing bucket and not in the operating budget. So the cash flow from operations will be higher for the capitalizing firm, and using the same logic, the cash flow from investing would be lower for the capitalizing firm, because this 900 is going in the CFI, cash flow from investing bucket, and reducing the CFI because it is money out. Debt to equity ratio, notice that the debt is not impacted by the decision of whether to capitalize or expense. So the liability is not impacted. The asset number is going to be higher for the capitalizing firm. If the asset number is higher, that means that the equity number is higher. If the equity number is higher, then the debt to equity is lower for the capitalizing firm. Interest coverage ratio is important. Initially, when the money is spent, your interest coverage ratio is higher for the capitalizing firm. So what is the interest coverage ratio? It is your operating profit, or EBIT, divided by the interest expense. In the initial year, EBIT is going to be higher for the capitalizing firm. Since EBIT is higher, the interest coverage is higher. But what about subsequent years? In subsequent years, the EBIT is going to be lower for the capitalizing firm because depreciation is included in EBIT and depreciation reduces EBIT. Therefore, we have a lower number for the capitalizing firm. Return on assets. Return on assets is net income over assets. In the initial year, the year where the money is spent, the net income is going to be higher for the capitalizing firm. The asset is also going to be higher, but generally the percentage increase in net income is much more than the percentage increase in assets. So overall, this ratio will increase. Example illustrates a scenario where you have two companies that are very similar. One expenses and the other capitalizes. So the company called Cap will capitalize. The company called Now is going to expense now. They both start with 1,000 cash and 1,000 equity. They have the same revenue. The first company and the second company, both companies purchase equipment for 900. Both companies have expenses other than this of 500 per year. Cap does straight line depreciation over 3 years, which means that it purchased this equipment for 900. So what is it going to show? It is going to show a depreciation expense of 300, 300 and 300 over years 1, 2 and 3. What will Now do? Now is going to show the entire 900 as an expense in year 1. All right. We are also given the tax rate. And then here are the questions. Which company reports higher net income over the 3 years? What is the difference in total cash flow? What is the difference in cash from operations? Do you think there will be differences in the numbers reported over the 3 years? Yes, there will be. Is there any economic difference between the two companies? Not really. From an investment perspective, they are identical, but clearly because they are using different methods, the numbers are different. The return on equity, profit margins, so these ratios are also going to be different over the years. The taxes paid over the years are also going to be different. In many cases, you will notice that the cumulative effect over 3 years is the same, but each year, when looked at separately, you will have different numbers. I am going to highlight the important points over here, and then there'll be a separate video going into details. But I think this is fairly straightforward, and I actually want you to try solving this on your own before you look at the solution. The first question is, which company reports higher net income over the 3 years? And then we also want to look at the cash flow numbers on the recording. So here we are looking at the numbers for Cap on the left and Now on the right. Notice that the cash expense other than the expense related to the $900 equipment is the same. But with Cap, the depreciation is 300 spread over 3 years, so total is 900. Whereas with Now, the total 900 is shown as a cash expense. So that is why the net income, or actually let's look at the income before tax first. The income before tax is only 100 for Now in year 1, and it is 700 for Cap. Okay, Cap has a higher income because only 300 is being taken as an expense. But then what about the tax? Cap is paying a higher tax over here because the earnings before tax is higher, whereas Now is paying a lower tax. Net income is 490 for Cap, and net income is only 70 for Now. What about over the 3 years? If you take numbers over the 3 years, 490 plus 490 plus 490, so in both cases, the numbers over the 3 years will be the same. Here you have 70 plus 700 and 700, so you are going to have 1470 in both cases. But when you take time value of money into account, then this would be better. But accountants who don't worry about time value of money will say that we have the same situation. Also notice that the income variability is higher over here because we are taking a big lumpy expense in the now scenario, whereas in the cap scenario, the expense is spread over a period of time. You can figure out the other numbers over here. They are fairly straightforward, and then I'll also make a separate video available on this. Question 2 deals with ROE and net profit margins. What you will see on the left is the calculation of equity times 0. Equity is the same for both companies, but then the equity numbers are different after that. On the previous slide, we calculated the net income numbers. Here we are calculating the equity numbers. So the ROE numbers are going to be different. The ROE for the capitalized company is going to be higher in the first year relative to the expense company. And this is intuitive because with the capitalized company, in the year of the expense, we are only taking the depreciation number. So the net income is higher. But in subsequent years, the ROE is going to be higher for now because there is no depreciation expense involved for the now company. All right. And with net profit margin, notice that the net profit margin is the same for all 3 years for cap, whereas for now there is more variability. Very low profit margin in the first year because we take the big hit, but then the profit margin numbers are better in subsequent years. I want you to also do these calculations. They are fairly straightforward. Why does now report a change in cash of 70 versus cap, which reports a change of cash of minus 110? You can work through the numbers here, but the big difference is the tax. Who is paying more tax? Actually, cap is going to pay more tax in year 1 because cap has a higher profit. So when the profit is higher, obviously it is paying more tax. So will that impact the cash flow? It will, because the tax payment is a very real cash flow. So that explains the difference.